There are at least 5 bills the average Canadian over the age of 65 is still paying every single year that they don't have to be paying.
Have you ever wondered if you're paying for something you no longer have to? Every year, thousands of Canadian retirees continue paying certain taxes, fees, and expenses simply because nobody ever told them there might be another option. The surprising part is that this isn't only about low-income retirees. It's also not just for wealthy Canadians with large investment portfolios. Whether you rely mainly on Canada Pension Plan and old age security, receive a workplace pension, or have retirement savings you've built over decades, there may be opportunities to reduce unnecessary expenses and keep more of your hard-earned money. Today's video will explore 5 common bills that many Canadian seniors may be paying when they could potentially reduce, defer, or eliminate them, depending on their personal circumstances. We'll also cover 3 valuable bonus strategies near the end that many financial discussions rarely mention. Before we begin, remember that every person's financial situation is unique. Tax rules, government programs, and eligibility requirements can change over time, so always verify current information with the Canada Revenue Agency, Service Canada, your municipality, or a qualified financial professional. Now, let's begin with one of the biggest opportunities available. Bill number 1, understanding tax credits available after age 65. Turning 65 doesn't automatically eliminate your income taxes. However, it does unlock several tax credits that many retirees either overlook or don't fully understand. Canada's tax system provides additional credits specifically designed for older adults. These credits can reduce the amount of federal income tax you owe. For many retirees with modest incomes, they may even reduce their federal tax bill significantly. One of the most important is the age amount tax credit. Depending on your income level in the tax year, this credit can lower the amount of tax you pay simply because you've reached age 65. Many retirees don't realize this benefit exists because it appears automatically only when a tax return is properly completed. Another valuable benefit is the pension income amount. If you receive eligible pension income, this additional credit may further reduce your taxes. When combined with Canada's basic personal amount and similar provincial tax credits, these benefits can substantially lower your total tax bill. For retirees living on modest retirement income, these combined credits can make a meaningful difference every year. Even middle-income retirees frequently qualify for partial benefits. That's why filing an annual income tax return remains extremely important, even if you believe you don't owe any tax. Filing isn't only about paying taxes. It's also how the government determines eligibility for many valuable benefits and credits. Missing a tax return could delay or prevent access to programs designed specifically to support Canadian seniors. The key lesson is simple. Don't assume you're paying the correct amount simply because you've always paid it. Take time each year to review your tax situation, confirm that every available credit has been claimed, and ensure your return accurately reflects your eligibility. A small review today could lead to significant savings over the course of your retirement. Coming up next, we'll discuss another overlooked expense tax that's being withheld from retirement payments that many seniors may not actually need to pay throughout the year. Now let's move to the second bill that quietly costs many retirees money every single month. Bill number 2, tax withheld from your retirement income. When many Canadians first begin receiving retirement benefits, such as the Canada Pension Plan, old age security, or workplace pensions, they choose to have income tax automatically deducted from each payment. For some people, that's exactly the right decision. But for many others, too much tax is being withheld. Think about what that really means. Every month, money is taken from your retirement income and sent to the government before you ever see it. If the amount withheld is higher than what you actually owe, you're essentially allowing the government to hold your money until tax season. While you may receive a refund later, that money could have remained in your bank account throughout the year. helping cover groceries, utility bills, medications, or everyday living expenses. The goal isn't to avoid paying taxes. The goal is to make sure you're paying the correct amount, not too much and not too little. Reviewing your withholding every year can help match your deductions more closely to your actual tax situation. This is especially important if your retirement income changes because of pension adjustments, investment withdrawals, or changes in your personal circumstances. Understanding the old age security recovery tax. Another issue many retirees encounter is the old age security recovery tax, often called the OAS clawback. Old age security is an important benefit for millions of Canadians. However, once your annual income rises above the government's established threshold, part of that benefit begins to be reduced. Many retirees are surprised when they notice their OAS payments shrinking without fully understanding why. The reduction isn't random. It's based on total net income. For retirees with higher incomes, careful financial planning may help reduce or delay the impact of the recovery tax. For example, managing retirement withdrawals over several years instead of taking one very large withdrawal in a single year may help avoid pushing taxable income above important thresholds. Similarly, selling investments or realizing large capital gains all at once can temporarily increase taxable income enough to affect government benefits. These situations don't affect every retiree, but understanding how they work allows you to make informed decisions before rather than after tax season arrives. The important lesson is simple. Review your retirement income regularly. Understand how much tax is being withheld. Know how your total annual income affects government benefits. Small planning decisions made today can have a meaningful impact on your monthly income tomorrow. In the next section, we'll look at a bill many homeowners assume they have no choice but to pay each year. The surprising reality is that many Canadian municipalities and provinces offer property tax relief programs specifically designed for seniors, but they often require you to apply before you can receive the benefit.
And apply a discount out of kindness. You have to apply. And almost every one of these programs has a hard deadline, often early in the year. Miss it, and you pay the full bill that year and wait until next year to try again. Why won't your municipality chase you down to claim it? Because every dollar you defer or get rebated is a dollar of revenue they don't collect. So you make one phone call. Phone your municipality or search your city or province plus the words Senior Property Tax Deferral and ask two simple questions. 1. What relief do you have for homeowners over 65? 2. Which of these are based on age with no income test? That one phone call has been worth hundreds, often thousands of dollars a year to people I've worked with at every income level. That's bill number 3. Bill number 4, the tax you overpay by not splitting it with your spouse. Bill number 4 is one most couples in this country have never even heard of, and it can be worth a small fortune. It's the tax you overpay simply because you and your spouse file as two separate islands instead of as a team. It's called pension income splitting. Here's the idea in plain English. If you're 65 or older, the CRA lets you move up to 50% of your eligible pension income, things like your RRIF withdrawals or a workplace pension, over onto your spouse's return just for tax purposes. The money still comes to you, you're only shifting where it gets taxed. You do it every year with one form, the T1032 that you both sign. Why does that save money? Because Canada taxes higher incomes at higher rates. If one of you has a big pension and the other has very little income of their own, you're paying tax at a high rate on income that could be taxed at your spouse's much lower rate. Shift some of it across, and the household's total tax bill drops. And for a lot of couples, we're talking $1,000, $1,500, $2,000 a year every year. That's not a one-time win. That's money back in your pocket annually for the rest of your retirement. And it does something else genuinely clever. Remember that OAS clawback from bill number 2? Splitting income off of your return lowers your own net income, which can pull you back under the clawback threshold and rescue your OAS at the same time. Picture a husband with a net income just over the clawback line. Move some of his pension income to a lower earning spouse, his income drops below the threshold, and the clawback disappears entirely. 2 wins from one form. There's even a bonus tucked inside the bonus. That $2,000 pension credit I mentioned back in bill number 1, when you split income over to a spouse who has no pension of their own, you can unlock their $2,000 credit too. So the household gets to claim it twice instead of once. Now, who does this help most? It's tilted toward couples where one spouse clearly out-earns the other. So above all, it's a middle-class and comfortable retiree win. But here's the mistake I see constantly. People assume the tax software will just handle it. It does not, unless you tell it to, and unless you actually file that election each year. Couples leave this sitting on the table year after year. If you're married or common law, and one of you has more pension income than the other, you owe it to yourselves to run those numbers. That's bill number 4. Bill number 5. The tax prep fee you never had to pay. Bill number 5 is going to feel almost personal because it's the fee you pay just to deal with all the others. Bill number 5 is your tax preparation fee. Every spring, millions of Canadian seniors walk into a storefront tax shop or a big-name chain and pay somewhere between $200 and $400 to have a fairly simple retirement return prepared. And a great many of those people legally qualify to have that exact same return prepared for free. There's a program built specifically for this, the Community Volunteer Income Tax Program, the CVITP, run by the Canada Revenue Agency together with community organizations right across the country. In Quebec, it's the Income Tax Assistance Volunteer Program. Trained volunteers complete tax returns free of charge for people with a modest income and a simple tax situation. And these free clinics aren't hard to find. They're hosted at senior centers, public libraries, Royal Canadian Legion halls, places of worship, community associations. You'll find them through the CRA's Free Tax Clinics page, and many run both in person and virtually now, so you can do it from your own kitchen table. And that phrase, modest income, really matters, because it is not just the very lowest incomes. The guidelines reach well into the middle. A single person or a couple living on CPP, OAS, a pension, and a bit of RRIF income very often fits comfortably inside the limits. Now, I'll be straight with you, because there's an honest line here that I won't cross. If your situation is genuinely complicated, you've got a business, rental properties, a complex estate, then yes, pay a real professional. It is worth every penny, and I would tell you to do exactly that. But if your return is 2 pension slips, your OAS and your CPP, and maybe a couple of investment statements, you should not assume you have to hand somebody $300 for what amounts to 45 minutes of data entry. And your age makes you eligible regardless of whether you're scraping by or doing just fine. Using that free help isn't being cheap, it's being smart. That's bill number 5, and it's one of the very easiest to act on this year. The 3 bonus moves. Now, I promised you 3 bonus moves, and I want to be straight about who these are for. The 5 bills I just covered reach right across every income level. These last 3 are specifically for the retiree who's built up something: a home that's appreciated nicely, an investment account, a healthy RRIF. If that's not you, please don't feel left out. The first 5 already had you covered, and you can skip ahead. But if you have built something up, these 3 can be worth more than everything else combined. And the low-income focused videos out there never mention them because their audience can't use them. You can. Bonus move number 1, the tax on selling your home. Here's the fear that lives in people's heads. You bought your house decades ago for $60,000. It's worth $700,000 now, and you're terrified that if you sell it, Ottawa is going to tax you on that enormous gain. So you stay put in a house that's too big, too expensive, and too much to keep up because you're scared of a tax bill. And in Canada, for most people, that fear is simply